Well, so what are the reasons not to sell anything in this bear market? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, please go to the website at prudentmoney.com. Send a question in and I will get that taken care of for you. That's all at the website, www.prudentmoney.com. Well, we got all done with the webinars last week and I had a lot of people sign up, a lot of people show up, and I think it was good information. If you want, and we typically don't do this because it's like, well, he's going to record it and he's going to let it offer it afterwards, so there's no incentive to go. Sometimes we do record it, sometimes we don't. We did record this one, and if you want a copy of the webinar, we talk about the 5 questions that you should be asking and the 5 questions that could save your retirement. Make sure that you send us an email at info@prudentmoney.com and we'll send you a replay of the recording of the webinar. So just info@prudentmoney.com, or you can go to the Ask Bob section at prudentmoney.com, whatever's the easiest to do. That's all at the website, www.prudentmoney.com. Well, investors are looking to their advisors for answers. Generally, it revolves around to sell everything or to stay invested in everything, to make changes. So today what I want to talk about and focus on is basically how to have better conversations and make decisions when it comes to money going through what we've been going through this particular year. And I wrote a blog today. You can go check it out at prudentmoney.com. And I talked about how we're in this unusual situation, which makes it a lot worse. And the situation is that we have both bonds and stocks losing money at the same time. I've gone back and put together a historical kind of a research on this, did some research, and I came up with 96% of the time bonds go up when stocks go down, so that there's diversification there. There is a place to invest when stocks are not going up, and there's a way to figure out, an easier way, let me say, to figure out what to do with your risk level. But like I said, today that's not the case, and it's just a tougher environment to rely, let's say, on the 60% stock, 40% bond, diversified portfolio. Much tougher to do. And the other thing is, from an advisor standpoint, you got to look at it from their standpoint, is they don't really, that was their answer. And that answer is reduce the amount that you have in stocks and go to bonds. But you're just going to one asset class to another asset class that's losing money, but maybe not as much as stocks, but bonds are losing money. I looked up just on an index fund, a bond index fund of a popular mutual fund company, and I talked about this in the webinar, that between January 1st and September 30th, that particular index fund, which was a bond index fund, which covered every type of bond, that it was basically a good representation of what the bond market, how the bond market's performing, was down 16% year to date through September 30th. 16%. And stocks were down by the S&P 500 were down like 21%. And in 30 years of talking about investments, managing money, being a financial advisor, I never seen anything like it. Never have seen. Like I said, there's a 4% chance that this would happen, and we're seeing it happen. And the other problem is that bonds, and of course if this continues to happen with interest rates, as interest rates go up, bond prices go down. Remember that relationship, and vice versa. Higher interest rates are not good for the stock market either. So you go to your advisor, and one of the things that I talked about, let me say this too. One of the things I talked about in the webinar is that it's important to understand what kind of substitutes there are for for bonds. There's actually a little bit of a substitute for stocks too. I'll touch on that in a second. But for bonds, there are places you can go, and that's what I wrote about today on the blog. You can go check it out. But there's places that you can invest that are what I call short-term substitutes for bonds. Bonds will have a period of time where they'll be a good investment again. Just not right now. I think bonds have got a long way to go before they're going to be what you would call a good investment. And the irony to that is it could be the best time in history to buy bonds, yet people won't touch them because they're afraid of the losses. That's the problem, is that bonds are looked upon as a safe haven. Most conservative investors will invest in bonds and use those for a means to balance out risk, and yet you're getting the carnage in the bond market thus far this year. Pretty tough situation. So the typical answer that you get when you go talk to your advisor is you want to, whatever the answer is basically telling you to stay the course. And then they'll give you a good reason why. What I've come up with is the 4 reasons. What will be the reply to that question, should I stay the course? I mean, staying the course, what that really means is to make a decision to not make changes. Or I guess you could say to not make decisions as well. And one of the points the very, very first point that I made out in the webinar is that there are really 2 big factors, and really focus on this. There's 2 factors that dictate the success or not success long term of an investor. And the first one is information. And one of the things that I talked about in the webinar was that with information, you have to get both sides of the story so that you can determine where you fit in to your opinion and your belief about investments. That's how we learn. Look at both sides, the pros and the cons, balance it out, figure out where you stand. And the pop culture finance answer is always out there in financial pop culture finance articles, resources. They're all over the web. So you know that side. Hopefully I'm bringing you enough of the other side that you can take what I say and balance it out. Because I do think that the answer is somewhere in between. I don't think it's one extreme to the other extreme. The other component of that process of being successful long-term as an investor, besides information, is the ability to be an effective decision maker. And I often think that we don't consider how important that is. I mean, think about how you make decisions. Are you a pretty quick decision maker? Too quick? Do you take your time? Do you take way too much time? I mean, one of the downsides of decision making is to try to find out all the information that you can, kind of being an over-preparer to make a decision. And you're looking for more and more information to back up why you want to make that decision, when at the end of the day, you're never going to get the absolute 100% information that you need to make a decision. There's going to be that risk that you're wrong. And you got to be okay with that. One of the things I talked about in the webinar was to go to your local bookstore, like a Barnes and Noble, assuming they're still there. I haven't been in a Barnes and Noble in a long time. but just a bookstore, and ask for books about decision making and go flip through them and find one that speaks to you and read it and be a student of decision making. I'm telling you, there's tons of books on decision making. I mean, you can go online, obviously, or go to Audible and download. And we've had some of those authors on the program to talk about how to become a better, more effective decision maker. But basically, to stay the course really means you don't have to take that risk of making decisions and being right or wrong. You just you don't have to make changes because you've decided just to go stay in the long term, and you hope that everything falls in place. And of course, you can listen to information. You kind of segment it. You pay attention to the information that supports your idea. You downplay the information that doesn't support your idea, and you wait and you hope it all works out. You know, the ideal situation would be that this bear market has hit a bottom and it's over with for the most part, starting a recovery process. I don't think that that's the case because that's not how bear markets work. There's a lot more to it than just that. And it would be where the hope comes true, and you don't have to make decisions. Because the reality is the market goes through good cycles and bad cycles. And when it goes through a good cycle, you use one strategy. When it goes through a bad cycle, like we are in one today, you go and use a totally different strategy to be effective. So what is the tangible reason you want to make a change? And we're going to talk a little bit about that on the other side of the break. Hey, this is Bob Brooks. You are listening to the Prudent Money Radio Show. Stick around. We'll be right back.
The Word for Today is excited to announce the new official online home for the ministry of Pastor Chuck Smith and Kay Smith, pastorchuck.org. At pastorchuck.org, you'll have instant access to thousands of hours of verse-by-verse teaching by Pastor Chuck Smith from Genesis through Revelation, and full access to special messages on subjects such as prophecy and much, much more. Also at pastorchuck.org, a full library of great teachings by Kay Smith, and a section where you can read some of Pastor Chuck's books online, all free of charge. So visit the new official online home of the Word for Today and the ministry of Pastor Chuck and Kay Smith, pastorchuck.org.
We all face trials and challenges on a regular basis. But what happens when the bottom just drops out of our lives? This week on A New Beginning, Pastor Greg Laurie provides help and hope when we just don't know what to do. Tune in for an important week of helpful encouragement this week on A New Beginning.
Weekday mornings at 7:30 on 91.3 KDKR.
Hi, I'm Jill Taylor, inviting you to join me each Saturday morning at 11 o'clock for Choose Life Radio. You'll hear people from across America sharing their stories of faith, forgiveness, redemption, and restoration. Choose Life Radio will encourage you to fully appreciate the gift of life. You may also find help for you or a friend in need. So please join me Saturday mornings at 11 o'clock right here on Bible School Radio 91.3.
Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. We're talking about information that you need to come to the decision of whether you should sell anything in a bear market. What are the reasons to do that? Well, if you go to your advisor, they're going to give you reasons for not to sell. And there are a couple of things you want to consider. But what is the tangible reason you want to make a change? A lot of times, people just want to make a change to stop the bleeding, to stop the losses. And what you have to realize is it's a bigger decision than that. The real decision comes down to, has my risk level changed? And if it is, what is my true risk level? And if I were to change to that risk level, well, how do things look long term as far as losses go? So for instance, let's say that you change your risk level to a very conservatively based investor. and you run the information on this, and you find out that you have to be able to tolerate at least a 10% loss at any given time. Now, you want to go with a strategy that will try to stay within those barriers, but that's all you're going to tolerate. So you got to look at it from the standpoint of, can I tolerate the bad times enough to stick with the good times? And if you can do that, then you are in the right mix. You're in the right risk level. But that, to me, is the question. Always the question. Like today, if you're struggling with your 401k plan, you've got to have a serious conversation with your advisor about what you're doing and say, am I in the right risk level? And if you're sitting there and not at peace, chances are you're not in the right risk level. You know, it's real easy to take risk when the market is unstoppable and it's going up, but it comes right down to the core situation when you get into a bear market like we've been into this year. So there are 4 different reasons what will be given to you more than likely if you talk to the average advisor. Number 1, they're going to tell you that you're a long-term investor. And they're going to tell you stay invested because the market, yes, it goes down, but it also goes back up. And history would show that the market always rebounds and comes back and you make your losses back. So you don't want to miss that. So you want to stay a long-term investor. I've always thought of that as that is a strategy for bear markets. Not a very good one, but a strategy. I mean, you're just kind of rolling your dice. What are the probabilities of a rebound today versus what are the possibilities of a rebound maybe 10 to 12 months from now and more losses? But they talk about the virtue of being a long-term investor. I've told this story before, but it's worth telling again. I'll never forget, during the financial crisis, Charles Schwab had a commercial out, and Charles Schwab is a institution on Wall Street, that huge broker dealer founded by Charles Schwab, named after him. And he's holding an investment meeting, and there's the tension. You could cut the tension with a knife. People were stressing. They didn't know what to do. In walks Charles Schwab. I'm not making any of this up. In walks Charles Schwab on this commercial, and he starts taking questions. And the guy he first says for the question, he goes, well, I've lost so much money. Do I sell right now? Do I do this? Do I do that? Do I make changes? And of course, people are watching it and were like, yeah, what do you do? And I'm thinking to myself, hey, this is Charles Schwab. He's probably going to come up with an intelligent answer. And he says, the market goes up, the market goes down, but the market always goes back up. And I thought to myself, is that really it? That's a legend on Wall Street, and that's the advice that he's giving. But the market always goes up, so you're in good shape. One of the things we talked about on the webinar last week, and you can get a copy of that by sending me an email at info@prudentmoney.com. Is to look at, instead of looking at a 50-year chart where the market always goes up, look at the times when it was bad and tell me, can you stomach that? How does that feel looking at the big gains and losses over a period of maybe 16, 18 years? How does that look to you based on that big picture? Well, I would imagine it doesn't look too good. And why this can be a long-term negative is that you get in the habit of, number 1, not making decisions, which does not further your ability to be a good decision maker, and to stay the course. Well, if you do that, when you get 3 years from retirement, you can have a real problem, because that is the time when you get to retirement, you need to be pretty well versed in making decisions when it comes to investing money. The long-term investor is the first one. Second one is, if you sell today, you'll lock in your losses. Now, here's what I never hear when it comes to that one reason not to sell. If you sell your gains, you'll lock in your losses. How come we never talk about selling our gains? Taking the profit off the table. It's as if paper losses don't matter, but paper gains do matter. When in reality, the thing that matters the most is that it's the value today if you needed the money. Not because it's on paper or you sold it and you put it in cash. It's what's the value today of that 401k plan that if you needed it, you would get it. Now, you might be saying to me, yeah, but that's a low probability chance. Might be a bigger probability chance than you think if things get really out of control and unemployment starts to skyrocket and the problems that could happen. So I would not look at it from this, once again, from the standpoint of the losses and the gains. I would look at it from the standpoint of what I'm doing today. Is it a mix? Is it a fit for my risk level? And if it's not, what changes do I need to make? Number 3, if you sell, you're going to miss out on a rebound. You're going to miss out on the market coming back. You don't want to do that. And then they start going through these exercises. Well, if you miss, one time out of the best times to be in the market, your 10% a year return turns into 1% or something like that. What's interesting, they don't do the study on the reverse of that. What happens when you miss the worst days of the market? And it's a huge difference. I should have brought that out and gone over it. But once again, you don't want to sell because you might miss out on something. You want to sell for a tangible reason, and typically, we'll talk about that here in a second. But you've got to be able to answer the one question. If you've gone through and figured out, okay, I'd be happy with this risk level and invested this way, what if the market took off and rebounded and you sold out of your riskier investments? Would you regret it? That's the question. Would you regret making that choice? And if the person can say confidently, no, I would not regret it because I would feel much better with this risk level. That looks better to me. And then that's a great decision. But if you said, yeah, that could bother me a little bit, then you haven't found the right risk level. And you got to continue to work with it. Then here's one of my favorites. Mr. Investor, there are more good years than bad years in the market. So if this year ends up being bad, we have another couple months left, then your advisor could say, yeah, but there's many more good markets, good years than there are bad. So you might as well just wait for the good years and rebound and profit from being in the good years because there's way more than bad. Well, there's a reason why there's more good years than bad years. And I'll give you an example. Between the October 2007 all the way to March 2009, which I believe is like 18 months, the market, that bear market, wiped out 14 years of stock market growth. That's why you need more good years than bad years, because you got to make up for all those lost years that can happen. But real quick, why do you make a change? First of all, a change in risk level. Your own personal risk level is definitely a reason to make a change. Second, at the individual fund level, if you've got in mutual fund XYZ and you're noticing that mutual fund XYZ is not doing well, it's doing worse than it should, you need to look into it, and you need to look at it individually. Maybe we need to change this fund out for a new fund and upgrade it. So there might be there might be an opportunity that you go through and you switch out funds that would work better for you in a rebounding situation, and even if it continued to lose. So you want to look at your overall risk level, and then the funds, which dictates the strategy, and the strategy dictates the funds that you're going to be using, and that they are effective for you. That's one of the things I constantly have to do, is make sure that these funds that we use for a longer term basis, which is not all of them, is they're still effective. And sometimes I end up changing them out, but that's very important as well. Hey, this is Bob Brooks. If you got a question for me, please go to the website at www.prudentmoney.com, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.